Hi everybody, Dylan here with Ross Financial, and I hope everybody's having a good start to their spring. As we're getting a little bit of better weather out there, so hopefully you guys are enjoying that. We want to shoot a quick video this week and talk a little bit about volatility, because over the last couple of weeks we've seen some ups and downs in the markets, and the majority of it comes from uncertainty. Market portfolio managers, individual investors, we don't know exactly what to expect because there's so much changing, and the market doesn't like uncertainty. But it's not a reason to be getting out of the market. It's not a reason to be panicking or worried. Volatility is actually our friend. I'm going to put a chart on the screen here, and I'll explain the chart, and then I'll get back to the point of what the takeaway is. But if you look at this chart that's on there, there's a bunch of gray bars that go across the top. And you'll see the different percentages. What those percentages denote are the end of year calendar returns for each of those years. So the market in 1980 was up 26%. But now if you let your glance go down a little bit to the red dots, what the red dots show are the low points, the intra-year declines in each calendar year. And so 1980 being a great example to start this conversation, even though the markets were down 17%, they ended up 26%. Sounds a little different when you put dollars amount in. So for easy math, let's say we had $1 million account. If your account had $1 million and it goes down 17%, you got to watch your portfolio value drop $170,000. But if you just hold and you don't sell, you don't panic, you don't worry, what you'll find is it would recover back to where it was, and then, oh, by the way, earn $260,000. There's a couple of other big notable ones on here. In the late 90s, the markets were down 19%. Ended the year up 27. And I don't know, for those of you that may remember the great financial crisis in 2009, markets were down 1.28%, but ended the year up 23. That's a change, a shift in that volatility of over 50%. So the takeaway from this is that volatility isn't something that we need to shy away from. The volatility and the downward movement short term is not what's going to affect the long-term performance of your portfolio. It's making inappropriate decisions when we see these red numbers. And there's been a theme for a handful of clients that have been worried that we've had conversations with. And that theme, really what we're kind of picking out and hearing a lot of different people say, is that this time's different. And the reality is it's not. It might feel different, but it's not. What that chart that we just looked at, all the red dots that are on here, what this doesn't show is the reason behind it. Each one of these red dots has a catalyst that denotes why the market went down. Something that caused uncertainty. Could be geopolitical conflict, could be an economic event, could be record high inflation, whatever it might be. It's on this chart. We've seen it before. So there's nothing really new that's going on with this market. It's just a matter of, it feels bad because we're seeing volatility, but the takeaway is, as long as you stay invested, as long as we don't make mistakes or we pull out of the market when we shouldn't, things will recover. And when it comes to folks that are taking distributions, we've got safe pockets throughout your properly diversified portfolio where we keep the money that we know you're going to need in the short term, and it's not tied to the market. So if you have any follow-up questions on this, if you are worried about the markets, don't hesitate to reach out. Don't hesitate to give us a call. We're here to help. We're here to educate, and more than happy to hop on the phone, spend 15, 30 minutes just talking to you about what it is that we're looking at and why you don't need to be worried and why we're not worried. So until then, take care.